Your mission, should you choose to accept it, and yes, she did, and the entire GST Council complied. The GST Council, led by Finance Minister Nirmala Sitharaman, has cleared the two-slab GST rate structure, with most items from 12% slab now slashed to just 5%, and those from 28% tax slab now at just 18%. Now, the new rates come into effect as early as September 22nd, the first day of Navratri, well ahead of Diwali that Prime Minister Narendra Modi had promised the nation on his August 15th Independence Day address. Now, the focus on the Next Gen GST reforms is on health and life insurance, fast-moving consumer goods, the daily essentials like the soaps, shampoos, hair oils and toothbrushes and toothpaste, as well as the white goods like ACs, refrigerators, television sets and more. Add to that, most cars are also now set to get cheaper. But sin goods like tobacco and some big cars, especially those above 1200 cc, more than 4 meters in the petrol case, and those above 1500 cc and more than 4 meters in diesel cars, now come in the 40% tax slab, up from 28% earlier. But remember, the 28% GST earlier also had the Cess component, and that Cess is now likely to go away from October 1st. Let's quickly take a look at what gets cheaper and by how much. So, health and life insurance, like I told you, has been slashed from 18% to nil tax, zero tax on insurance premiums. And then there's daily essentials like the hair oil, shampoo, soap, which has now been slashed to 5% from 18% earlier. There's also packaged food like butter, ghee, cheese, namkeen, and the tax on that has been slashed to 5% from about 18% or so earlier. Even electronic appliances like AC, refrigerators and television sets have now received a reprieve in GST from 28% to 18%. And petrol hybrid cars as well as diesel hybrid cars, those that are under 4 meters in length, as well as motorcycles up to 350 cc, have now received a tax cut, a GST cut from 28% to just 18%. Electric vehicles, EVs, the focus of this government. No change in the tax there. GST stays at 5% for electric vehicles. Well, let's put all of this into perspective and discuss with a very special panel of experts here joining us this morning on News 9. Barnik Chitran Metra, P Investor Managing Partner, Chrysalis Equity Ventures, Mitali Nikore, Founder and Chief Economist, Nikore Associates, and Ritesh Kanodia, Partner, Ortis Legal. Thank you so much, all of you, for joining us here on this very important day. Less than, 12 hours ago, 11 hours ago, we had the surprise press conference. Finance Minister has gone ahead and delivered on what we are calling mission accomplished, and GST has been slashed. First words from all of you. Mitali, let me give you the opportunity first. This was something that was expected, but the fact that there's going to be no resistance, the fact that a 2-day GST Council meet will be cut down to 1, and there's going to be absolute unanimous voting on going ahead and cutting rates. What does this mean for the consumer?
No, absolutely, Karthik. I think today is literally the start of Diwali. I think Diwali has come early, and definitely we are seeing celebrations from all over. I think everyone is sort of understanding the implications of this. So, just if we can understand it from a high level perspective, it is evident that the focus has been on making the GST far more progressive than what it used to be. So, what we are seeing is that the essential commodities, especially food items, are now coming into either the 5% bracket or the 0% bracket, both of which are very good news because there are several food items that have been moved from the 12% but also from the 18% bracket into the 5% or 0% bracket. So, that's the first key takeaway. The second key takeaway is around health, and I think that is very critical to understand. A lot of life saving drugs, a lot of medicines, a lot of health equipment, medical equipment being taken from the 18% or even 28% bracket straight into the 5% or 0% bracket. This will have massive impact on health expenditures across the country. And the third aspect is really around taking the education supplies and education services as well from a 12% to a 5% bracket. Again, an essential expenditure being brought down to the 5% bracket. And the most important, I think, the headline
Yeah,
is really around insurance and the
that's
fact
right.
that insurance becomes 0%. Health and life insurance is 0%.
Absolutely. Perfect. I think, Mitali, you should have been in the studio and you should have been anchoring the show because you summed up exactly everything that the GST Council has decided to go ahead with. But, Barnik, there are also some question marks, and those question marks are also important to note. And the first question mark is that essentials and FMCG, you can't really increase the consumption beyond a certain point. It's not that because prices are cheaper, you're going to brush more times a day or you're going to bathe more times a day. So, overall, is all of this cut in GST, which is going to reflect lower prices for the consumer, really going to boost consumption?
So it will boost consumption only in pockets, right? I think we should not assume that every single thing where there's a GST cut, we will see an economic equivalent price elasticity, which will result in demand, right? But if you look at certain elements like capital goods purchases, even looking at things like cars, scooters, vehicles, right? Even looking at things like air conditioners, some of these things, as they become more rationalized into a lower category, right, there will be some capital expenditure which will help. If you remember the economic data for the last quarter, even though India grew at 7.8%, right, which people are still questioning a little bit, right, but there is real slowdown in a few sectors. We look at automotive, there's surplus capacity building up, right, FMCG sector is slowing, right. While the rationalization and simplification is welcome, I don't think this will solve the full problem of the consumption growth, but again, it'll at least set the basis for triggering a little bit of stimulus. I did some math. In an average Indian household, this is likely to put, from a daily expenditure point of view, on an annualized basis, maybe 30, 40,000 rupees more in the
Right.
hands of the consumer. And I
Okay.
think what this will happen is people are expecting that around the Diwali time or the New Year, between the last quarter of the calendar year, some of this money will get spent, right? May not be on FMCG daily items, but more on
Yeah.
capital goods like refrigerators, air conditioners, and the like, and cars, right? Which will again go back to the full Make in India story. So
That's right.
again, not all sectors will be benefited equally, but I would suggest that if you look at India's thrust on Make in India and domestic production, particularly capital goods, which are slightly higher value, right, which is in the tens of thousands of rupees, I think this should create an incentive for people to either prepone purchases or even accelerate purchases going forward, right? And then I think the only thing now left is a cut in the interest rates so that people can now finance some of this cheaper. So I think all of this is coming together, but again, it's a good first step to getting back to a higher consumption story, which India is always poised for.
Right. So a good first step and a major one at that. But Ritesh Kanodia, there is also something, that Mitali referred to towards the end of what, when she was answering my first question, which was around the focus on health insurance, life insurance, and the premium on those insurances now slashed to zero. Now, last time we had you on the show, Mr. Kanodia, we were talking about the fact that this input tax credit may counter impact the cut in GST, and insurance providers may not be able to offer cheaper premiums to consumers. But now that the GST Council has gone ahead and slashed the premium from 18% earlier to 0% now, where do you think the insurance companies stand? Will they have to pass on some benefit to consumers?
Yeah, hi. Good morning, everyone. So let me first start with this entire discussion on consumption and just give a slightly different facet to
All
this
right.
discussion.
Okay.
See, one of the key issues that were existing was also the disputes in classification between an 18, 12, 5 and 28% and the complex GST rate structure, right? What the government has done is by reducing the rate slabs to 2, they have actually eliminated a huge amount of disputes between the different products. There was this entire issue of a popcorn, which is liable at a higher rate versus a lower rate, etc. So that is one big
Popcorn
thing
and
that we
non-butter
have.
popcorn, packaged popcorn and
Absolutely.
loose popcorn. Yes, of course, we all
Yes,
remember those
probably
debates.
that was the largest news item that I read today, that no disputes in popcorn now. So
Right.
that is one big thing. The other thing which we need to also understand is that ease of compliance, right? Because when a rate is 12 or 18, a lot
Yeah.
of people tend to be outside the GST chain. So that is what the government is sort of expecting, that the tax buoyancy will increase.
Okay.
A lot of players will become compliant. So it is not merely a consumption story. I think it is also about being
Compliance
more
story.
compliant.
Right.
Yes, it is also a ease of doing business. So that was my first point.
Okay.
Now you mentioned about input tax credit. That's not merely an issue of insurance, but that
Okay.
is actually an issue of all sectors now.
All right.
Since
Why is that? So
morning,
just break it down, simplify. Why does input tax credit become a problem if tax rates come down?
so let us take a scenario where I am today charging tax at the rate of 18%.
Right.
Correct? Now, the input tax credit comprises of two components. One is an input and another is an input service.
Right.
Typically, the input service is all at 18%, nothing changes there, right? Nothing goes down there. And that usually comprises of around a 40 to 50% component, especially let's take FMCG, where advertisement cost is massive. The royalty or the brand fee that they might be paying to their foreign supplier may be massive, right?
Sure.
So all those credits with a 5% rate of tax gets accumulated in their books. And then what to do with that credit? The delta is huge. So
Correct.
the debate which is now going on, and since the morning I've been having this debate, is whether I should write it off because there is no potential of utilization. Now, if I write it off, which means that has to be added to my cost. So
Okay.
a reduction of, let's say, 12 to 5 or an 18 to 5 looks like that the reduction would be 12 or an 18%, but that's not the scenario. The reduction is likely to be less because that delta of input service credit has to be passed on.
Sure.
And just specifically answering to your insurance
Right.
question,
Yeah.
exemption means no credit.
Okay.
And so what I've been reading is the effective rate of tax would somewhere be around 8 to 10%, not zero.
So 8
Now,
to
how much of it?
10% also from 18% is a good 10%, 10 percentage
Absolutely.
points
See,
lower. So at least that should reflect in the premium, shouldn't it?
there is no doubt that there is going to be a rate reduction, effective rate reduction to the end customer. There is absolutely no debate around it.
All right.
But the discussion to say that 18 becomes zero is an unrealistic discussion.
All right.
One
Sure.
aspect which the government probably needs to look at is a refund of input service tax credit accumulation, which
All
is
right.
a long-standing demand. If that happens, then yes, this is a very big thing.
Input service tax credit is still under contention, is what you're trying to say, Mr. Kanodia. Point
It's
well
not
taken.
eligible.
It's not eligible.
refund
Point
is-
well taken. But one could also argue, since you were giving the FMCG example, one could argue that there are input costs accumulating to insurance companies also. At the end of the day, even they advertise and even they have field agents and even
Yes.
they have
Sure.
printed material and office spaces and rental, and all of that should reflect in input tax credit for them.
Yes. So the distinction is input health premium is exempt, which means no
Right.
credit.
Right.
FMCG is liable at 5% with credit, so accumulation. So effectively, if they are not able to utilize accumulation, it leads to the same end result. As I mentioned, there will be the effective rate will not be 5% or zero.
Okay.
It would be somewhere higher because of the loss of input tax service credit specifically.
All right.
So we are not looking at
So that's
absolutely.
the big input coming this morning from Mr. Ritesh Kanodia, that despite GST being slashed from 18% to zero on health and life insurance premium, it's important to note that because of the limited offset of the input tax credit, you could still end up with your policies being cheaper by at most just about 8 to 10% and nothing beyond that. Not the entire 18% reduction is going to be passed on to consumers. Point well taken, Mr. Kanodia. Mithali, I want to now come to the government's finances. And yesterday in the press conference, and in fact, even speaking to reporters, the statement that came from the GST Council was that the revenue loss to the exchequer is likely to be to the tune of 48,000 crore rupees. Now, 48,000 crore rupees also becomes, of course, added incentive for consumption, but at the end of the day, it also sort of, disrupts the equation of the tally of the fiscal deficit. So is there merit in the government now really reassessing its fiscal health, fiscal position, and coming up with another estimate of fiscal deficit target for this year? Or do you think the consumption boost and the corporate tax collection and all of that is going to offset this 48,000 crore rupees of loss by way of lower GST?
So I think, Karthik, 48,000 crores is actually a very small figure.
Okay.
When we look at the size of the overall government
That's right,
expenditure.
because average tax collection is anything between 1.8, 1.9, even as high as 2 lakh crore rupees a month on just GST collection. So 48,000 does not ring an alarm bell per se. But do you think it's going to be limited to just 48,000 crore?
So absolutely, Karthik, because if you look at the way the GST changes have been done,
Yeah.
as I was mentioning, this is a highly progressive reform. So we've gone to, taking a lot of essential goods, a lot of health-related goods, food-related goods, education-related goods to a 5%. But then we've also taken a lot of sin goods. We've taken a lot of high-value goods, luxury goods, from 28% to 40%. Now, when you take those goods to 40%, you are doing a very clear calculation. This is not going to have such an impact on the demand of the luxury goods because the segment of the population which is demanding those luxury goods is actually highly inelastic. It's demand is not going to change with a small change in price.
Absolutely right.
And as a consequence, yeah, and as a consequence, we are sort of at a point where luxury cars, if they are taxed at 40% instead of 28%, they bring in a lot more revenue. But the demand for those cars does not necessarily fall because you're talking about an income segment which is able to afford that luxury car at the 40% GST as well. So, it becomes much more revenue neutral in that sense.
You're right, absolutely. But Barnik, I want to sort of give you the last word here on, and just taking forward the points that Mithali is making here this morning, that a 40% tax is going to actually not pinch those who can afford those big cars and those big wheels. But the point really is that I believe, and my understanding is that now by eventually getting rid of Cess by the 1st of October and rolling everything into a higher GST also means better tax buoyancy for states, better tax distribution among states, and not just the 28%. I beg your pardon, the entire Cess amount first just remaining with the central government. So now with this 40%, in any case, the cost of cars is likely to come down, even if it is the bigger cars that Mithali is talking about, because you don't have the Cess component from 1st of October, but there's going to be better distribution across states, so more equitable growth. Does that seem to be a valid argument?
No, it is a valid argument. I think let's look at the numbers in retrospect, right? I think the 48,000 crores, let us assume the government has got its math correct, right?
Yeah.
At the best case, it is foregoing around 3 to 5% of its annual GST revenue, right? Again,
Sure.
if you assume 2 lakh crores into 12, that's 24 lakh crores, this is 2 or 3%, right? So if you put all of this in perspective, the real effective tax loss, right, which it is doing beyond the cess, right, is just 2 or 3%, right? And which can easily be made up by small spending cuts there and may also be made up by buoyancy. I think the bigger thing to take away is the overall point on simplification, doing away from cess and moving towards a more equitable balance between center and state, which is what the states have been demanding for. And I suspect that the reason why this lower slabs were quickly agreed by a lot of the states was because of the prospect of seeing a higher share of the revenue collection, which there has been complaints from particularly opposition ruled states, is that the center takes disproportionate share. So as a reform, I think this is a thing in the right step, in the right direction. I think the magnitude can still be questioned. I still personally question why should we have so many categories at 18%? Maybe the median rate should be closer to 14, 15%.
All right.
The magnitude of foregone revenue is only 2 or 3%, which
right.
means at the end, right, they're actually not letting go of a big reform, which is why I'm saying the median household will see only a few thousand or up to 20,000 rupees more,
Sure.
which is significant, but not substantial enough to move the needle. But again, let's welcome it for what it is. It's a step in the right direction. It's a reform which has been long overdue. Popcorn or no popcorn, I think at least it simplifies it. I think the only people who will be complaining about it are tax accountants and chartered accountants because their burden comes down.
Absolutely.
But again, step in the right direction, maybe a little too late, maybe a little too little, right? But again, we hope that will only get better as we move forward, right? And we will see more dramatic cuts as the tax buoyancy increases with more compliance.
Absolutely. On that positive note, let me take this opportunity and thank my guests here this morning, Barnik Chitran Metra, Mithali Nikore and Mr. Nitesh Kanodia. Always a pleasure. And thank you so much for joining us this morning on this very important story.